Hello everyone, welcome to today's class. We are actually continuing from the series on the double entry principle of bookkeeping and the ledger account classification. In our previous classes, we have mentioned the importance of understanding the double entry principle of bookkeeping, and then we had some practical examples. We then move to the classification of ledger accounts, and we were able to start with a part of it. Today we are continuing, and it's going to be the last in our effort to ensure that you understand the basic principle of bookkeeping. So today we are looking at this diagram in front of us on the screen. We had a diagram also in the previous class, but this one is a bit is in support of the one we had before to further simplify the understanding of the account classification, as it has to do with what has to be debited and what has to be credited. This is very, very important. This background, this foundation is very, very important for any accounting person, whether as a student or as a worker and the accounting staff. It is very, very important because this is the basics. If you don't understand this background knowledge of accounting, it is difficult for you to be able to pass any entry in accounting successfully. So let's continue. In the last class we discussed about the assets being part of a classification of account called the real account, and we discussed what assets is all about, and its other aspect, which is fixed assets and current assets. So today we look at this diagram. This is the ledger account itself, divided into two: the debit, the left hand side, and the credit. This is the debit on the left hand side of your screen, and the credit. This is where the double entry principle of accounting is derived. The ledger account is a primary book of account. So this is the principle which states that every debit entry must have a corresponding credit entry. And this is why a balance sheet, as the name implies, must be balanced. Both sides must be balanced, the debit and the credit. So this is the background, this is the basis. Okay, so we are looking at it at the debit side. On the debit side, that is what we mean by debit side is the side, the balancing of a particular account, the side it should be, whether debit or credit. So on this debit side, all these accounts, all these names, all these account classes are debit balance. That's what we mean. Like the assets, the fixed assets, the current asset, they are all debit balances. They are all debit balances. So whenever you are handling any accounting transaction and you see that assets are being acquired, whether it's fixed or current, either they are starting their opening balances and all of that, or whenever the account is debit, that's what it means. It's debit. So when it is a fresh transaction, you debit it if it's an asset, whether it's fixed or current. Like when you buy stock, what do? You debit your purchases, which is stock, so to say. And when you buy assets, whether it's building or motor vehicle or whatever, they are debited. That's what we mean here. Okay, so now on the right hand side, which is the credit side, we have the liabilities. The liabilities are credits. So it means here that everything under this credit are supposed to be credit balances. That is liabilities, which is made of the current liability and which include long-term liability and then the equity. So today let's look at the liability. We have been able to define assets and the assets, fixed assets and current assets. Let's look at the liability before we come back to the other aspects of the accounts. So let's look at liability. Liabilities are those things the business organization owe to its other business partners, such as its creditors, its suppliers, and other associates that it owes for one thing or the other, either for supply of goods or for supply of for rendering of services or for borrowing, whatever it is. That's what liability is, what the company owns outside the business, and is divided into current assets or current liability or long-term liability. Current liability includes account payable, like those that fall due within a period of 1 year, and then long ones are those that fall due after a period of 1 year. Okay, then we have the equity. The equity is the contribution of the owners of the business, the share capital, the capital invested, the cash they invested or they introduced into the business, and all of that. That's what the equity is. Okay, so all of this side are a credit balance. They are a credit balance. Then if you come to the middle, you will see that part of the debit balance we have assets, expenses. Expenses are also debit balance. They are debit balances, expenses. While on the other side of the credit of the liability or the right hand side, we also have income, which is also a credit balance. And all of them, the expenses and income, make up what we call the nominal account under ledger account classification. The nominal account. Remember, we have dealt with the real account, which comprises of assets and liability. You can see from this line, from here, this is asset to here, connecting to this place, real account connecting to liability. So assets and liability are what we have as real account, which they include this current liability, equity, or long-term liability. They all fall under real account, or sometimes personal account is also here. They are all the same. They have the same balancing, real account. Whereas which we have dealt with, then the next classification is the nominal account, and this is the two. The makeup of the nominal account is the expenses and the income, and they are credit balance. The income is a credit balance, while the expenses is a debit balance, and both of them are what we call profit and loss items or income statement items. This tells us that expenses are not to be treated as balance sheet items. They are not balance sheet items. Expenses here include the cost of running a business. When expenses are incurred, the cost of paying salaries, the cost of paying for rents and all of that. Whereas income is the gain or profit that comes as a result of the business. That's what income is all about. So, and they are charged to profit and loss account or income statement. Please take note, because most students and even employees, working class, misrepresent this particular aspect of the account. They will take expenses and treat it as a balance sheet item. They are not balance sheet item. they are under nominal account, they are profit and loss items. And then you now see that the assets, which are the real account, the assets, and the liability, which are the real account, they are balance sheet items. You can see this line connecting liabilities to balance sheet and assets to balance sheet. Okay, so all of these are assets, all of these are liabilities, and this is connecting them to balance sheet. So they are balance sheet items, whereas the income and expenses are profit and loss items. So this is very, very important for you to know in treating any accounting question or transaction. The understanding of this is very, very key. Is very, very key. Every debit entry must have a corresponding credit entry, and the debit account or debit balances account are assets in general, of course made of fixed asset and current asset. And then expenses is also a debit balance account. And then for the credit balance accounts, you have the liabilities made of the current or long-term liabilities and then equity, and they are called balance sheet items, the balance sheet items, and are classified under the real account. The assets, the liabilities make up the real account, and they are balance sheet items. And then the nominal made up of expenses and income account. Expenses and income, that's under the classification nominal account, expenses and income. The expenses is of course the debit balance, and the income is a credit balance. The two of them make up the profit and loss account, meaning that they are charged to profit and loss account. So this is the understanding, the how it is. Please take note of this particular description. It will help you to understand the double entry principle of accounting and account classification, as it has to do with account classification, because the both of them are together. Okay, so in our next class, this will be the final on this series, as it has to do with the double entry principle of accounting and ledger account classification. This is the last series. What we will do next in our next video or in our next class will be an illustration. I'm bringing this for us to understand, so that when we start taking illustration, we'll be making reference to them, so that it will be clearer to us. I will come up with a general practical illustration that will take care of all that we have discussed under the double entry principles of account and the account or ledger classification, so that it will drive home the point that we are trying to make. So I will see you in the next class. Thank you for watching.